Pass-through taxation. Sole proprietorships, partnerships, S corporations, and LLCs are all subject to pass-through taxation. These are known as pass-through entities, which means that these are entities which are not paying taxes on their own. Instead, their profits or losses will pass through to its members to be reported on their personal tax return. All profits are only taxed once at each member's individual income tax rate. In this case, the IRS does not consider these businesses to be separate entities from their owners. Any profits the business brings in are automatically considered as being personal profits of the LLC's members. For this reason, an LLC taxed this way cannot lower its tax burden by reinvesting profits into the business. Pass-through entities are also responsible for paying 15.3% of their profits in employment tax, unless you have an LLC or a partnership which is taxed as a corporation, which can be done with the help of an accountant or a CPA by filing a form with the IRS in which you can choose to have your LLC taxed like a corporation rather than a pass-through entity. So I will explain. If you have an LLC and would like to take advantage of the retained earnings, net profit after dividends are paid, while still enjoying pass-through taxation, it may benefit you to elect being taxed as an SCorp. SCorp owners who work for the business have their profits distributed as salaries rather than distributions. So after you pay yourself a salary, the remainder of profits can be retained in the business or divided among the owners as non-dividend distributions. In general, like I said, the owner of a pass-through entity is required to pay both personal income tax and self-employment tax on their regular wages received from their business. But opting to be taxed as an S corporation provides the difference that retained earnings are never subject to self-employment tax, even when they are distributed to owners. This method of having the benefit of a pass-through taxation while also benefiting from the SCorp special treatment, it's pretty used by many coaches, including I, who are formed as LLCs and act as self-employed. The key is, in order to avoid raising eyebrows from the IRS, having a pass-through entity and being taxed as an SCorp, you must limit the amount of profit you retain in the business and be sure to pay yourself, the owner, a reasonable salary for your industry based on your position. Most importantly, talk to an accountant about all this before you make any choices. I suggest you do that. How are losses handled with pass-through taxation? Just like profits, LLCs taxed as pass-through entities report their losses on their personal tax returns. While the specifics can vary significantly depending on your business, your reported losses will reduce your overall tax liability. The pass-through entities offer their owners two main benefits. One, the structure is simple and allows owners to combine their personal and business income for tax purposes. This can be particularly helpful for smaller businesses looking to streamline their operations. And two, all business profits are only taxed once at the owner's personal tax rate. This differs from corporate profits, which must deal with double taxation, first at the corporate tax rate and later at the shareholder's personal rate when distributed as dividends. And we will talk all about double taxation in the next lecture. These features can make pass-through taxation an attractive option, but it does come with some disadvantages if you just keep that. One major downside to pass-through entities is what I've already mentioned in the course, the requirements that they pay employment tax on all profits. This 15.3% employment tax covers both the employee and the employer portion of the Social Security and Medicare tax. While S corporations or an S corporation taxation option can reduce the employment tax burden by retaining a portion of the profits, all wage earnings are still subject to both income tax and employment tax. If you are in the United States and you are hiring an accountant or a CPA, they will tell you about the new 20% pass-through tax deduction that was created as an additional advantage for pass-through entities, as mentioned in the Tax Cuts and Jobs Act of 2017. The Act says that pass-through entities owners can deduct up to 20% of the company's qualified business income on their personal tax returns. So, ask your accountant what the best tax option for you is. But before that, let's go together to the next lecture and talk about corporate taxation or double taxation as it is also known. So this may create a bigger picture with everything that's going to come in the course. So I hope that at the end of this course, you're going to be able to choose the best business structure, the best taxation type, the best strategies that you want to use to move forward and be successful in your business.